Welcome to TalkTickers, we're your shortcut to understanding the key insights from today's earnings calls.
And today we are jumping right into NLY Capital Management first quarter 2025.
Yeah, we're going to pull out the key takeaways, look at the financials, and really get management's perspective on navigating, well, what's clearly a pretty volatile market right now.
Okay, so first glance, the results snapshot. NLY actually reported a positive economic return. Came in at 3% for Q1.
3%, okay. That feels pretty solid given the backdrop.
It is, and it looks like that gave them confidence to increase the common stock dividend. It's up to 70 cents per share now. That suggests some earnings momentum.
Right, and book value, I saw that dip slightly.
It did, yeah. Book value per share was down less than 1% compared to the last quarter. But like you said, factor in that dividend payout, and that's how you get back to that 3% positive economic return.
And importantly, it wasn't just one area carrying the load, right?
Exactly. All their main business segments, Agency, MBS, the residential credit side, and MSRs, they all chipped in positively to that economic return figure. A pretty broad-based contribution.
All right, let's unpack that a bit more. Starting with the big picture, the macro environment. Sounds like Q1 started okay, maybe a little deceptively calm.
Well, yeah, initially it seemed relatively stable, even though the 10-year Treasury yield bounced around about a 65 basis point range, which isn't insignificant.
But then March happened.
Right. Things started to deteriorate a bit in March. A lot of talk around the new administration's potential trade policies seemed to spook the market somewhat. Risk assets underperformed.
And spreads widened out again.
And spreads widened, yeah. Some of that earlier tightening just reversed course. And then April really turned up the heat.
Significant volatility, it sounds.
Very significant. The trading range in Treasury yields just in April was apparently similar to the entire first quarter's range. That's a big move.
Wow. And the impact?
It led to a sort of cheapening of assets that need a lot of balance sheet things banks hold, and Agency MBS spreads definitely widened out.
So how did NLY react to all this turbulence?
Management really emphasized a prudent approach. They talked about keeping economic leverage low, so not borrowing too much relative to their assets and maintaining really strong liquidity, just being cautious.
Makes sense. Okay, let's dive into the specifics. Their agency business first. Looks like they were actually adding to the portfolio.
They were. The agency portfolio grew by about $3.5 billion in notional value. The focus was on buying intermediate coupon TBAs.
TBAs to be announced securities. Why those specific ones?
They offered a pretty good mix of favorable convexity, that's how sensitive the bond price is to rate changes, and also decent carry, the income you get from holding them.
And hedging. How do they manage the risk side?
They stayed disciplined there. Interestingly, they shifted away from longer-dated swaps and towards Treasury futures earlier in the quarter. That was because swap spreads were widening out at the time.
A tactical shift based on relative value.
Exactly. But then, after the quarter ended, things flipped a bit. MBS widening became more pronounced compared to swaps because swap spreads actually tightened back in relative to Treasuries.
So the relationship shifted again.
It did. The hope or expectation seems to be that once this macro stress dies down, the market will refocus on the fundamentals for MBS. The fact that they look relatively inexpensive, prepayments are pretty slow, and financing is stable.
Okay, let's switch gears to residential credit. That portfolio actually got smaller.
Yeah, it decreased down to $6.6 billion. That was partly due to some opportunistic sales selling when prices looked good, and also because they ramped up their securitizations in Q1.
And what about credit spreads in that non-QM space?
They widened out too, both in March and after the quarter ended. But importantly, the new issue market stayed open. Deals were still getting done, and those spreads have come back in a bit from their widest levels.
And the housing market itself, we hear so many conflicting things. What was their take?
It's really interesting. They highlighted a national slowdown in home price appreciation momentum. HPA is cooling off overall.
But it's not uniform.
Not at all. They're seeing regional differences emerge. Some weakness, particularly in the South and Southeast, but actually seeing strength in the Northeast and the Midwest. So quite a divergence.
Despite that regional variation, they still see the national picture as stable.
Generally, yes. Because borrowers still have a lot of equity, delinquencies remain pretty low, and underwriting standards over the last decade have been tight. So the foundation looks okay, even with some regional cooling.
And their own loan creation businesses.
Yeah.
Enso Bay and OBX.
Sounded like they were firing on all cylinders. And Sobe, the correspondent channel, had strong lock and acquisition volumes, and the OBX securitization platform was busy, closed 6 deals in Q1.
Including a new type of deal.
That's right, their first ever HELOC securitization, home equity lines of credit. And they didn't stop there, priced 2 more deals after the quarter ended as well. They're still manufacturing their own credit assets, aiming for those mid-teens ROEs.
Okay, onto the MSR business mortgage servicing rights. Portfolio size looked pretty steady.
Yeah, relatively unchanged at around $3.3 billion. They did settle that big chunk of previously announced purchases, about $28 billion in principal balance.
And added some new ones, too.
They did, about $3 billion through bulk deals in their flow channels, but they were pretty disciplined about growth.
Why hold back on growth there?
They mentioned anticipating elevated supply coming to market in 2025, so maybe waiting for better pricing, being strategic. They also highlighted aligning with their subservicers and recapture partners as a key way to gain an edge.
How's the MSR portfolio actually performing? Valuation and fundamentals.
The valuation ticked up modestly. That was helped by a steeper SOFR curve, the short-term rate benchmark, and also tighter spreads on some of the deep out-of-the-money collateral.
And the underlying performance. Delinquencies, prepayments.
Still exceeding expectations, apparently. Delinquencies remain low, and the portfolio CPR constant prepayment rate was running at just 3.4%, so homeowners aren't prepaying very quickly right now.
Let's pull in some of the core financial numbers. Earnings available for distribution, EAD. How did that look?
Pretty consistent, actually. Came in at 72 cents per share, same as the prior quarter.
What supported that level?
Lower average repo rates, their funding costs were down a bit, and higher coupon income from their assets. That helped offset lower income they were getting from their swap positions.
And that ties back to the dividend increase, right?
Exactly. The strong EAD is why they felt comfortable bumping the dividend to 70 cents. And importantly, they signal they expect to keep it at that level for the rest of the year.
Okay, good signal for income investors. We touched on book value earlier, down slightly to $192.
Right, a small dip. But again, when you add back that dividend, you get the positive 3% economic return. And digging into the components, they saw gains in the Agency MBS portfolio, the Resi credit book, and MSR's hedging movements were a slight offset.
How about their funding situation? Access to cash, liquidity?
Seems very solid. Funding markets were described as robust. They actually increased the average term of their repo borrowings, locking in funding for longer at good rates.
Yeah, expanding capacity.
Yep, expanded warehouse capacity for both Resi credit and MSRs. Plus, they ended the quarter with $6.3 billion in unencumbered assets not pledged, and $7.5 billion total available for financing if needed. Lots of flexibility.
Efficiency ratios ticked up a bit.
Moderately, yeah. But they expect that to normalize going forward. Seems like a temporary blip, perhaps, related to Q1 activity.
Right, the Q&A session often gives some extra color. Let's talk about book value post-quarter end. It was down a bit more.
Yes, they confirmed it was down roughly 3.5% after quarter end, but that includes the dividend payment. So adjusting for that, the underlying move wasn't quite as dramatic.
And that dynamic between mortgage spreads widening and swap spreads tightening came up again.
Definitely. It's a key theme. It's driven by, well, volatility for one, but also how the swaps market itself has evolved since Dodd-Frank. Swaps have kind of become the main risk-free benchmark curve now, which changes hedging dynamics.
So what's the outlook for swap spreads then?
The expectation, or maybe hope, is that they'll normalize and widen out again once there's more clarity on trade stuff and vol comes down.
And regulation could play a part too. SLR, Basel Endgame?
That's another potential driver. The thinking is that potential regulatory changes, like tweaks to the supplementary leverage ratio or a reproposal of Basel Endgame rules, could actually be a tailwind for swap spreads widening in the coming quarters, basically easing bank balance sheet constraints.
Interesting. What about leverage? They mentioned keeping it low, but did it move at all?
It ticked up slightly, but they stressed it's still inside of 6 turns, so still relatively low historically for them. They're trying to balance taking advantage of wider asset spreads with managing the higher volatility, sticking to a cautious approach until vol subsides.
But they see upside if spreads do tighten.
Oh yeah. They acknowledge the portfolio has significant upside potential if spreads come back in.
Let's revisit that move into intermediate coupon agency MBS. Why the focus there?
It really came down to relative value. They saw attractive valuations and good carry in that part of the coupon stack. And with a general bias towards maybe lower rates eventually, Intermediates still look appealing.
But they're not only buying intermediates.
No, they're opportunistic. They mentioned keeping an eye on higher coupons too, especially specified pools with certain characteristics, if the price is right.
And prepayment speeds, refi speeds. The expectation is faster than historical norms.
Yeah, even for relatively small rate moves. The reasoning is basically bigger loan sizes today, and the larger role of non-bank originators means the mortgage universe is just more sensitive, more negatively convex than it used to be.
Okay. And housing prices, they reiterated the regional aspect in the Q&A.
They did, expecting moderation to be regional, often driven by pockets of increased inventory hitting the market short term. But the long-term fundamental picture for housing, they believe, is still constructive.
Did they comment on how the private label securities market held up during the recent volatility?
Yeah, they noted it showed good resilience. They were still able to price transactions successfully even during that choppier period, which is a positive sign for that market.
What about the big picture stuff, like GSE reform? Fannie and Freddie.
Viewed as a much longer-term issue, any move towards privatization would need to be really thoughtful, they said, to avoid disrupting the whole mortgage market.
But if the GSEs did shrink their footprint eventually.
That could actually be a positive for NLY, potentially benefiting both their agency and their residential credit businesses by creating more opportunities outside the GSE box.
So right now, where are they seeing the best opportunities to put new capital to work?
Currently, Agency MBS seem to offer the most attractive marginal returns, mainly because those option-adjusted spreads, or OAS, have widened out. But creating loans via OBX and securitizing them remains a core focus too. MSR growth seems more price-dependent.
And that first HELOC securitization, how did that go over with investors?
Sounded like a success. It apparently attracted some new investors to their platform, folks interested in floating rate assets, which makes sense for ALCs.
What about the near-term supply and demand picture for Agency MBS?
Before the recent volatility spike, demand was pretty strong, particularly from fixed income funds and also from CMO creation. Foreign demand, especially from Asia, is something they expect might pick up more once the Fed actually starts cutting rates more definitively. How tariffs might impact that flow is still a bit unclear, though.
And on the non-agency side, has the volatility impacted their pace of buying loans?
It has, yeah. They mentioned the rate and spread volatility has made them build in a bit more margin when acquiring new loans. So maybe a slightly more defensive posture there too, reflecting the uncertainty.
Okay, so bringing it all together for the investor context. This call really reflects a company navigating, well, a lot of uncertainty. Rates, macro, policy. It's choppy waters.
Absolutely. And their strategy, keeping leverage relatively low, maintaining high liquidity, that looks like a very deliberate choice to manage through this specific environment. It's about preservation and being ready for opportunities.
And those longer-term themes, like potential regulatory changes and the future of the GSEs, they're definitely hovering in the background, could mean significant shifts down the road.
For sure. And watching how the different segments, agency, resi credit, MSRs perform, gives you real-time insight into what's happening in the broader fixed income and housing markets right now.
All right, let's pivot to our This Is Not Financial Advice segment. Time for an outrageous but plausible trade idea based on all this.
Okay, idea number one. We heard a lot about swap spreads being tight, potentially due to regulatory constraints on banks and the expectation they might widen later, maybe with regulatory easing.
Right, and NLY likes intermediate Agency MBS.
Exactly. So what if you went long Agency MBS, maybe focusing on those intermediate coupons, but hedged it with short positions in Treasury futures instead of swaps?
Betting on swap spreads widening relative to Treasuries.
Precisely. You're playing for that normalization. If swap spreads widen as bank balance sheets get potentially less constrained, that could boost the MBS position relative to the Treasury hedge. You might capture spread widening and potentially benefit if overall volatility calms down. It sort of aligns with NLY's positioning too.
Interesting angle. Okay, outrageous idea number two.
This one plays on the housing market divergence. We heard about regional weakness, particularly in parts of the South, but also that the non-QM securitization market held up pretty well.
Okay, so a regional credit-focused play.
Kind of. Consider maybe a long position in senior tranches of some recently issued non-QM RMBS residential mortgage-backed securities, specifically pools with collateral from those potentially weaker southern regions.
Long the senior bonds from weaker areas. Seems counterintuitive.
Well, the thesis is that even if home price appreciation cools significantly in those areas, the borrowers in these non-QM deals often have substantial equity, and the tight underwriting protects the senior bondholders. You couple that long senior RMBS position with maybe a short position in a homebuilder ETF as a macro hedge against a broader housing downturn.
So you're betting on the credit quality of those specific non-QM borrowers holding up, even if the local market softens, while hedging the bigger housing picture.
Exactly. It's a play on structural protection in the non-QM deals versus broader market sentiment reflected in homebuilder stocks. Definitely requires digging into specific deal structures, though.
All right, definitely two ideas to mull over there. So wrapping up today's deep dive into NLY's Q1 call, we've covered their positive return, the dividend boost, their cautious balance sheet strategy, and their views across mortgages and housing.
Key takeaways are definitely that positive economic return, despite the volatility, the dividend increase signaling confidence, that careful positioning with lower leverage, and just getting the detailed perspective on all these moving market pieces.
And just to reiterate, those trade ideas, purely illustrative, food for thought, not financial advice. Always do your own homework before making any investment decisions.
Absolutely. And maybe a final thought for you, the listener. How do you see that interplay between regulation and mortgage spreads playing out? And how are you thinking about those regional housing trends impacting the different types of mortgage investments? Lots to consider.